Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for July 11th, 2022. What I would like to do on this segment is to review how far behind is Main Street to the fundamentals. We're going to take a look at basically the current headlines that we have regarding inflation, earnings, and retail sales coming out this week. Another hot inflation report and the start of earnings season. European markets open to close. Jobs reports, inflation data, and the Feds. Housing inflation is worse than officials' BLS data show. Stock market today, stocks move lower with earnings season, inflation. Bond yields fall as inflation fears swirl. So what I'm trying to point out here is that the word inflation is all over the news. It's all over the map. It's all over the internet. It's all over Main Street. And when I look at the reality of where we are and what the market is telling us, I wanted to take a look basically at some of the components that are responsible or indicators what they're telling us in terms of the real market condition. The fundamental information is usually lagging behind the real market. And there is a catalyst to the shift in the trend of the markets basically, and that is the cost of financing, the cost of money, the cost of borrowing margin, the cost of leveraging, the cost of lending money, the cost of borrowing money. And that's what's become really a major headline as we take a look at what really is being outstanding in terms of the sentiment of the market. One of the key indicators that we're looking at is the 10-year note, which is the relationship, you might say, of the yield curve between the 10-year and the 30-year. The 10-year is where the short end of the market parks its money, and right now you're looking at a 3% yield. Now, what I want to point out to you that we are running at inflation levels that potentially could exceed 8.6%. according to the media. So we have a gap, just based on these numbers, that we're running of a negative yield of about 5%. If we use shadow stats, the inflation rate is far greater than what the media is publishing. It's more like 16, 17%. Using the 1970s formula. So, if that is the case, then we're looking at a wider negative yield spread. So, what has to happen basically is that either the Feds have to raise interest rates more aggressively, or inflation has to be coming down. So what I want to do before we take a look at the robo-advisor reports for the rest of the week is I want to take a look at basically the markets individually and see what it is that has happened with regards to inflation. If we take a look at the soybean market, the high that was made was 1470, but let me take a look at the bigger chart. 1784 was the high that was made on June the 9th. 1784. And the market has collapsed to 13 to make a low of 1304. It's about a $4 over $4 and almost $4.80, almost $5 correction in the month of June. This is soybeans. It's one of the leading indicators of food prices as we entered into this period of geopolitical conflict between Russia and Ukraine. The market went up to 1784. And that was the high that essentially was priced in the Russia-Ukraine war. Even though we have eliminated about 30% of the world's grain production, the price of soybeans reached a high of 1784, and it pretty much confirmed that it discounted those fundamentals. And it pretty much now wanted to see the effect of this rally here with regards to the cash market availability, the availability of grain, the actual grain to be made available to world consumption. If we take a look at wheat, we saw a high in wheat of 1363.50. This was made on March the 7th, right into the Russia-Ukraine conflict. This priced in the war and the disruption of supplies from the region at 1363. It came down to a low last week of 785. From 1363. That's a huge drop of over 40% since the high was made. We're talking about grains. We're talking about the main source of the inflationary spiral that everybody's talking about. Let's take a look at corn. The high was 824.50, and that was made on April 25, right after the Russian-Ukraine conflict. And the market came right down into now what we're looking at is this major uptrend channel, and the market jumped right above it. So we have three of the major grain components of inflation Let's take a look at crude oil. We saw a high of 130.50. On March the 7th as a consequence of the Russian war. And we came down to a low of 95 on July the 4th. Well, you can see here, basically, if we take a look at energy, commodities, and if we take a look at precious metals, we saw a spike in gold of 2078 on March the 7th as well. And we came down to a low last week of 1726. That's a huge move in a short period of time. Silver. On March the 7th, made a high of 27.50. And last week, we made a low of 18.70. Let's take a look at the NASDAQ. On April the 4th, the high was 15,198, and we have come down to make a low of 11,068.50. That's a huge, huge move in a short period of time. Now, what I'm pointing out to you basically is that the data that we're getting with regards to inflation is old news. The market is way behind, or Main Street, I should say, is way behind the market. And one of the things that I'm looking at is basically that we have seen a deflationary move over the last just few months, contradicting basically all this media news headlines about inflation hitting record highs. They're behind the curve because in reality, what we're going to see over the next few months is inflation coming down. As this move that we have seen in commodities, metals, energies, stocks, has been a deflationary move against what the fundamentals seem to indicate is inflation running wild. Inflation. When you begin to see that kind of saturation on Main Street or the media, it measures the sentiment of the market, and the majority of people follow that sentiment. And so one of the things that I'm doing here is I'm looking into where the markets are right now and what they're telling us moving forward from here. The 10-year note is an indication of the cost of money, and if we look at the 10-year note trading below 3%, it's a bullish indication, and we are trading below 3%. It's a very bullish indication, basically contrary to what the fundamentals are saying, in that inflation is running wild, therefore interest rates are going to have to go up. I believe that the markets already have peaked with regards to interest rates. I believe that the markets have discounted at least 3/4 of a point increase on the next meeting, and possibly the next 2 meetings. But the yield coming down below 3% may be indicating here that the economy is slowing down. Deflation is basically the next headline that you're going to see, that you're going to hear. People are not talking about this deflationary move that we have seen, contrary to the tremendous news about rising rates and inflation. So what I'm doing here is I'm taking a look at basically where I'm going to make my next dollar and where my traders, my subscribers, are going to take advantage of this situation as well. So for that, I use the Robo-Advisor weekly report, which is basically the standard deviation levels provided by Nikki the Robot. Let's take a listen to it and see what it tells us here as we come into this week.
Hello everyone, this is Equity Management Academy with the Gold Weekly Standard Deviation Report for July 8, 2022. Summary: the weekly trend momentum of 1824 is bearish. The weekly VC PMI of 1761 is bearish price momentum. A close above 1761 stop negates this bearishness neutral. If short, take profits 1706 to 1850. Next cycle due date July 30th, 2022. Trading instructions. Weekly trend momentum, 1824, bearish. The gold futures contract closed at 1741.
So what I want to point out to you here is that the weekly trend momentum is the big trend. The overall big trend of the market. By the fact that we close below the 1824, and we use the 9-week moving average to identify that cycle, that trend, the big trend. The market closing below it activates a bearish trend momentum. And this is one of the components that we use to identify the big trend picture, you might say, with regards to where we are.
Market closing below the 9-day SMA 1824 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Cycle. The next cycle date is due July 30th, 2022. Strategy. The weekly trend momentum is bearish unless it closes above 1824.
So the Robo-Advisor is telling us that even though the trend is bearish, if we close above 1761, it's going to negate this bearishness to neutral. So it begins to shift the trend momentum, and a second close above it will activate a bullish trend momentum.
Weekly price momentum, 1761, bearish. With the market closing below the VC weekly price momentum indicator at 1761 is confirmation that the price momentum is bearish. A close above the VCPMI would negate the weekly bearish short-term trend to neutral. Cycle. The next cycle date is due July 30th, 2022. Strategy. The weekly price momentum is bearish unless it closes above 1761. Weekly price indicator. Exit, longs. Sell 1, 1795. Sell 2, 1850. Exit, shorts. Buy 1, 1706. Buy 2, 1672. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1706 to 1672, and go long on a weekly reversal stop. If long, use the 1672 level as a stop close only, and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1795 to 1850 during the week. Cycle. The next cycle date is due July 30th, 2022. Strategy. If short, take profits 1706 to 1672.
Let's take a look at the daily chart in gold, basically, and see what Nikki the robot was telling us here. If we take a look at the left of the chart, these are the weekly mean. This is the weekly mean that Nikki the robot is indicating to us. And so the market trading below that is bearish, and it has activated the 1706 to 1612 below. When the price trades below the mean, it's bearish. It's a bearish price momentum. The VCPMI is the mean or the standard deviation within the bigger trend that we looked at, which is bearish. And the same principle applies when the price closes below. It's bearish. So we have the price trading below the weekly trend momentum. We have the price trading below the weekly standard deviation, and we have active targets at 1706 to 1672. Now, it doesn't necessarily mean that the prices have to come down to these levels. What this indicator does for us is it gives us a very detailed mathematical map that we want to follow, which is basically the standard deviation of the market. And using these pivot points, which are activated with the algorithm, it identifies for us the areas, the trading areas. In green, which is the mean or standard deviation. In blue, it is the extreme below standard deviation. The buy 1 is a 1-to-1 standard deviation. The buy 2 is 2 standard deviation. Now, we use the data weekly and daily. And so if you take a look at the data on, this should be the buy 1 level, daily, and the 1727 is our second buy 2 level or 2 standard deviation. So the price is trading between the daily buy 1 level and buy 2 level, and also is trading right around the the daily mean of 1740. I think there's a little bit of let me just double check the data here. There's a little bit of a mixed up in here. Let me just correct this. And this is the daily. Two standard deviation level that we're looking at. 1740 is the daily average, the daily mean, the daily standard deviation. And so daily, the market has activated a 1727 target. But if it closes above 1740, you're looking at the targets of 1753 to 1765 activated. So we have a bit of a mixed signal right now. But what you see here on the 8th at pretty much made a low of 1726. And that came right into the daily now support levels that we're looking at. So we have a little bit of a mixed signal here in gold, but trading above 1761 is going to activate a bullish weekly price momentum, and right below it's giving you buy signals. So it appears that we are in an area very close to a bottom in the market here, in the gold market. And it's recommending for you to buy, if activated, again, 1727 to 1714, all the way down to 1706. This area, from a mathematical probability, you're looking at a 90-95%. If this area is activated, it will activate a reversion to the mean principle that will bring the market back up to the weekly standard deviation mean of 1761. So trade from the long side, look to buy corrections if activated, and I think that this is so far the path of least resistance in terms of the rest of the week for us. I'm sorry I didn't have time to get into silver and the NASDAQ here, but I will try to do that in the next few days. In the meantime, my friends, please have a great trading day, a great trading week here, and I will talk to you real soon.